Welcome to this explainer. Today, we're diving deep into the massive financial shockwaves that literally just rippled across the globe. We're talking about an overnight shift that sent traders scrambling, totally redrew the map for major asset classes, and fundamentally changed how the world's most powerful central bank communicates. If you've been glued to the charts this week, wondering why everything suddenly looks like a roller coaster, well, you're in the exact right place. We're going to break down exactly what happened, why it matters, and how you can actually navigate the fallout.
So let me ask you this, who or what just sent global markets into a sudden tailspin overnight? You might guess it was a surprise earnings miss from some massive tech giant, right? Or maybe an unexpected geopolitical flashpoint. But nope, the real catalyst? A single meeting in Washington, D.C. and a set of statements that completely caught investors off guard.
Section 1. The Era of Kevin Warsh. You see, the highly anticipated June 18th FOMC meeting wasn't just your routine check-in. It marked the absolute dawn of the Kevin Warsh era as the new chair of the Federal Reserve. Naturally, the market was watching with bated breath to see his style, his priorities, and, crucially, his stance on the economy's most stubborn problem. But here's the funny thing. At surface level, the actual outcome was kind of boring. The Fed held interest rates perfectly steady in a range of 3.50% to 3.75%. That's the fourth consecutive time they've left rates untouched. And what's absolutely crucial to understand here is that this wasn't some fractured, debatable decision. It passed with incredibly high consensus among the members. The market had entirely priced in this exact pause. So if the rate decision was exactly what everyone expected, why on earth did the markets completely flip out?
Section 2. The hawkish message. The real shock to the system wasn't the rate pause itself. It was the surprisingly aggressive, totally uncompromising tone that came with it. I mean, the market went into this meeting hoping for just a whisper of easing, a subtle hint that rate cuts were somewhere on the horizon. Instead, they walked face first into a brick wall. Chair Warsh used exact, deliberate wording, explicitly stating that the committee is resolute and united in returning inflation to their 2% target. He made it crystal clear that inflation is still a massive risk, and hitting that 2% goal is their absolute undisputed top priority. The central bank basically said, look, we are simply not ready to signal any loosening of monetary policy. They poured freezing cold water on any hopes for a quick pivot.
And take a look at the very first point on this release. We are literally witnessing the death of traditional forward guidance. Think about it. For years, the Fed has essentially held the market's hand, basically telegraphing its future moves way in advance to prevent surprises. While Warsh is tossing that entire playbook right out the window. He explicitly noted that forward guidance is not well suited to the current environment. He wants shorter policy statements that just give the facts. Going forward, the Fed is relying strictly on real-time data. That means no more promises to the market about what they're going to do next month or next year. You're on your own. But wait, the biggest bombshell of the night? I call it the dot plot twist. So, the dot plot is that chart where Fed members anonymously project where they think rates will be down the line. The market totally expected these dots to show rate cuts. Instead, the data showed multiple members actually leaning towards another rate hike in 2026. I mean, talk about shattering market expectations, right? And incredibly, staying totally true to his new communication style, Warsh himself didn't even put his own dot on the board. He flat out refused to forecast his own future moves. Unprecedented stuff.
Section 3. The dollar surges. Now, this aggressive shift instantly created massive ripples across global finance. When the Fed comes out and says, hey, we might hold rates higher for longer, or maybe even raise them, the immediate knee-jerk reaction is a massive spike in the power of the US dollar, because those higher yields attract global capital. Just look at the sharp visual impact right here on the DXY. After several sessions of looking pretty weak, the dollar aggressively broke above that critical 100 mark. It jumped over 0.9% literally overnight. As short-term bond yields spiked right alongside the Fed's newly revealed hawkish stance, the market fiercely repriced its expectations. In the short term, the scales have aggressively tipped back in favor of the mighty greenback.
Section 4. Gold braces for impact. So a soaring dollar usually spells absolute doom for commodities, right? And man, the precious metals market just went through an incredibly volatile, total whiplash-inducing ride. I want you to picture gold right now as a heavyweight boxer. When Warsh delivered that hawkish message, gold took an absolute brutal right hook. The punch was a devastating 3.7% drop, violently breaking down from a resistance level around $4,390 per ounce. I mean, honestly, most assets would be out for the count after a hit like that. But then, we saw the resilience. Gold refused to stay down on the mat. It found aggressive bottom-fishing buying support right around $4,238 per ounce and just sprang right back up. So why did it bounce? Despite the surging dollar and rising bond yields, both of which theoretically should totally crush gold, the metal remains a remarkably resilient star. Why? Because the structural support under it is just immense. We're seeing massive, continued buying from global central banks. Major investors are heavily using it to hedge against long-term systemic risks. And literally, as soon as the price dipped, bottom-fishing demand flooded the market, easily absorbing that intense initial selling pressure. Basically, gold took the Fed's absolute best shot, and it is still standing.
Section 5. Equities tremble. While gold managed to shake it off, the U.S. stock market faced its first real test of gravity in months. After a seemingly unstoppable, months-long rally, the major indices took a pretty severe hit. The Dow Jones was brutally rejected right at its all-time historical high, dropping about 1.65%. The broader S&P 500 fell roughly 1.5%, and the tech-heavy Nasdaq, it took the worst of it, sinking nearly 2%. It was a sudden, sharp, and very real shakeup.
Just look at this violent vertical drop on the NASDAQ 100 index here. But what you absolutely must remember is the context. The sea of red had absolutely nothing to do with corporate profits, okay? Companies aren't suddenly making less money. This sell-off was driven entirely by monetary policy fears. It was the sudden realization that the era of easy money and predictable Fed cuts is simply not happening the way everyone planned.
Now, before you panic and liquidate your entire portfolio, hold on. There is a massive, crucial caveat here. The underlying narrative driving the market, specifically the whole artificial intelligence boom, remains incredibly strong. The major institutional players aren't viewing this as the end of the bull market at all. They see it as a necessary technical correction within a much longer-term uptrend. In fact, the moment the market dipped, aggressive buy-the-dip money stepped right back in, erasing a good chunk of the initial panic. The AI story hasn't cooled down one bit, not even close.
Let's broaden our lens to the global stage for a second to see how the rest of the world is digesting all of this. It's a wildly mixed bag. The US, as we just discussed, is super volatile right now, but the long-term trend still looks upward. Europe, on the other hand, is largely shrouded in gloom, heavily weighed down by these shifting macro winds. But then, look at Japan. The Nikkei 225 is the brightest star in Asia right now, continually surging and breaking out. Why? Because massive waves of capital are flowing directly into their industrial and tech sectors. They are completely shrugging off the Fed's hawkishness.
Which brings us to the absolute ultimate question you have to ask yourself as an investor today. We are officially in a new paradigm. The Fed has explicitly told us they are done holding our hands. They will not map out the future for us anymore. They're going to react to data as it happens, and you are going to have to do the exact same thing. So look at your allocations right now and ask yourself, is your portfolio ready for a Fed that no longer telegraphs its punches? Are you genuinely prepared for the sudden volatility of the Kevin Warsh era? Think on that, because the age of predictable central banking, it's officially over. Thanks so much for joining me on this explainer, and remember to keep your eyes on the data.